So I'm just going to act as a gentle warm-up act, and another disclaimer just to kick on with. And this is what we're going to be looking for. Just looking at it, I'm a generalist. I'm not an expert in their field like Tim and Abby. So I'm going to quickly make what I would argue is the case against UK equities, the case for UK equities, and a few global trends that may have make their presence felt as well before coming to a few conclusions. So the case against UK equities, well, given that the FTSE 100 is still trading a fifth below its January high, this probably isn't too hard to make in some cases. So what's the case against? COVID-19 or déjà flu, and I can take no credit for that. That's from the front cover of Private Eye this week, so if you don't like it, blame them. Brexit, and then you could also dig a little bit deeper into the quality of earnings, particularly at the FTSE 100 level. So COVID-19, it's a fiercely difficult job trying to deal with the virus, particularly when so many people who carry it are asymptomatic, and there are multiple problems. But I know that not everybody's been wild about necessarily all of the policies that have been posed. And looking at it from the purely dispassionate point of view of share prices, the UK has been a laggard over the past year. That's the grey bar. And it's lagging, perhaps has got even worse since the 21st of February, when financial markets began to actually take COVID particularly seriously and not just dismiss it as another sort of swine flu or minor Asian problem. And you could, if you're being perhaps uncharitable, say that maybe the UK has not dealt with the pandemic as effectively as some nations. It's certainly noticeable that Asia ex-Japan, for example, has outperformed substantially post the pandemic, even though that is where it started. Now, that may be because that they were better prepared because of SARS and swine flu. It may be that their healthcare systems are more adapted. It may be that simply their population is more obedient when told to wear a face mask and lock themselves up, so there are multiple possible reasons for it. But you can argue, potentially, if you're in a bad mood at least, that the UK's underperformance has got worse under COVID, and it certainly hasn't got better. Now, from a Brexit perspective, this is since the Brexit vote to the day in June 2016, and this is capital return in sterling terms. So yes, clearly the fall in sterling on the announcement of the Brexit vote has helped inflate those overseas returns. But nevertheless, I think it's fair to say that the UK equity market has not exactly covered itself in glory since Brexit. That again is not to make a political statement. It is perhaps of anything to reflect that dreadful word, and perhaps overused word, uncertainty, as financial markets still necessarily don't quite know what it's going to mean. And we're getting pretty close to the deadline, or the latest of a long series of deadlines, starting in January next year. So the uncertainty that's caused with regard to trade relationships, currency, and a number of other, and even politics, what it's possible to argue, just looking at the bold numbers and nothing but the bold numbers, that again, Brexit sentiment-wise has not been helpful to the case for UK equities. Now, quality of earnings. This just looks at the percentage of forecast profits growth and the percentage of forecast dividend growth from the FTSE 100. Those of you who are familiar with our dividend quarterly dividend document, a dividend dashboard, will recognize some of these charts. But as you can see, I mean, we are looking at, in theory, on paper, a pretty big bounce back in earnings and dividends in 2021. But you can see here, looking at the biggest columns on the left-hand side, which sectors are, according to analyst consensus, expected to lead the charge. Oil and gas, financial, obviously banks and insurers, consumer discretionary, to a lesser degree industrials in terms of earnings. And then on the right-hand side for dividends, again, banks and insurers, followed by a little bit of consumer discretionary and mining. Now, I was a technology analyst at UBS Investment Bank for 12 years, from 1993 to 2005, and I thought covering tech was pretty tricky, but I thought it was a heck of a lot easier than covering technology and banks and covering banks, oil and gas and insurers, where I think, coming up with accurate forecasts really is a heinously difficult job. So I think you can argue that relying upon those sectors and those earnings forecasts to drive your profits and dividend growth is a pretty fraught exercise. Now, the good news at the moment is oil is actually rallying a little bit. You may be seeing the yield curve steepen a little bit to give the banks some help. And if we don't get a double dip recession, that will help the banks with their loan books, and maybe mean that the write-downs they've taken so far are sufficient. But they are very, very unpredictable areas. Also, although there is potential for quantity of earnings in 2021, the quality isn't necessarily brilliant, and that quality indeed could still come back to haunt you on the quantity side. And again, it's another reason why the UK has underperformed, you would say, markedly relative to Asia, or even and particularly to America, where in the US clearly tech and healthcare have had a huge influence. and so far at least have been offering a pretty fair tailwind. So quantity of earnings, fingers crossed. Quality of earnings, it's just very, very unpredictable. And again, that comes back to the uncertainty word. And when markets feel there's uncertainty, they don't like paying high multiples for things. And that's why I've seen the UK, generally speaking, trading at pretty hefty discounts to some of its recent history. So that's the bad news out of the way. What's the case for UK equities, which, let's face it, may be less obvious, but that in itself, to an actual contrarian like myself, and that's not just because I'm a bloody-minded Yorkshireman, does perhaps mean that there may be something to go for here. Well, here we go. Unloved, potentially underestimated, and therefore, as a result, potentially undervalued. And ultimately, it is the price that you pay to access a security in its cash flows that ultimately determines your returns. So valuation is perhaps one thing that the UK has at least got in its favour. Now, we've already seen that they're unloved. UK equities have underperformed for quite a long time. In fact, probably even going further back than Brexit, if you look at the numbers, hindered by COVID, hindered by Brexit, the uncertainty, hindered by lack of technology exposure and a host of other issues. Even political uncertainty has been a big one. There were, a year ago, would have been sat here talking about the possibility of a Labour government and privatisation of public assets. Now, that one's gone away for now. But nevertheless, lots and lots of different worries have been floating around the UK for several years, indeed predating Brexit. A lack of appetite for UK stocks is clear. I hope I'm not putting the jinx on Tim's imminent fund launch, but you've seen 2 UK equity fund launches both fail recently, Buffettology and Tellworth British Growth and Recovery. So that tells you that nobody's interested. Now, again, for contrarians, that's a red rag to a bull. And if you are a contrarian, these are certainly two creeds by which you will hold. The cave you fear to enter holds the treasure that you seek, and wandering away from the action is the way to find the new action. And in a way, this week has been a microcosm of that, with a big outperformance from value relative to growth, although that actually seems to have started perhaps back in the summer if you really look at the numbers very closely. And although two fund managers weren't able to raise the money due to lack of interest, somebody somewhere must think there's some value to be had in the UK, because we've had 6 or 8 bids in the last couple of weeks alone, whether it's RSA, McCarthy and Stone, Horizon Discovery, for example, Codemasters just yesterday. So even if investors aren't necessarily wild about UK equities, somebody somewhere thinks there may be something up for grabs. Now, underestimated, we talked about the quality of FTSE 100 earnings, but at least there is this potential for quality. On the left-hand side, you can see the forecast analyst bounce back for pre-tax profit and dividends. And yes, the higher the oil price goes, the steeper the yield curve gets, the stronger the economy, the stronger the global economy, the more confident you can be in those earnings. And let's face it, a vaccine is a pretty strong step in that direction. And on the right-hand side, perhaps one of the biggest narratives in UK equities this year, has been dividend cuts. That was a long-standing plank for exposure for UK equities, to UK equities. Some pretty meaty dividend yields. Admittedly, dividend cover has been low for some time, as we've been discussing in that dividend quarterly dashboard product. And as soon as you ran into trouble, now admittedly, I think a lot more trouble than anybody dared imagine, we walked into some very substantial dividend cuts, over £40 billion worth of dividend cuts announced in the UK so far this year. But as you can see, since May, the red bars, dividends paid, and the black bars, dividends restored, have begun to creep higher. And although October let the side down as HSBC, Shell and BP came through with their latest quarterly dividend cuts, since the summer, the numbers have actually favoured payments and restorations over cuts. So there is just a possibility that we're through the worst there. And the UK is still on paper offering about a 3.5% yield for 2020 and just somewhere near a 4% yield for 2021. Now, if that is met, I accept it's a big if, given the quality issues that we've discussed previously, that could still look really pretty tempting at a time when central banks don't look to be in a galloping rush to raise interest rates. So there is the potential that the UK is underestimated, particularly on the dividend side. All of the headlines are still being written by cutters, but actually it's payers and restorers who are maybe just starting to sneak up on the rails. And that takes us to valuation. Again, this now looks at the all share, slightly broader, but the FTSE 100 is 80% plus of that anyway. The PE doesn't look particularly challenging, and that's at a time when earnings are pretty depressed, and the yield still looks pretty tempting, again, at a time when things are under pressure. A lot of companies have clearly prepared for the worst and hoped for the best, which is the right way of doing it, and they have husbanded resources accordingly, and they are now, in certain cases, feeling just brave enough to dip their toe back into the water and nip back onto the dividend list. I think we should be able to draw some encouragement from that. So in terms of global trends to watch, which may have some impact, well, we've touched upon them already. I mean, ultimately, markets have been really this year torn between the battle between the irresistible forces in immovable objects. You know, the irresistible force has largely been a pandemic, and one that may still not be under control. We've had a steep recession. Could we get a double dip if the pandemic really makes its presence felt again during the winter, as clearly that the health authorities are concerned it's capable of doing? And then even as and when, and let's think positive, we come out of the pandemic, you know, what are the long-term effects upon behavior? Will people feel sufficiently confident that they do want to go back to commute, go back to packed offices, walk up and down the high street, go to the cinema, or will there genuinely be long-term effects upon behavior in terms of urban conurbations, commuting and working patterns? Many questions to ask there, not on an individual stock and sector basis as well as market-wide. Now, to combat those forces on the other side, we've got monetary stimulus in the form of interest rate cuts and quantitative easing from central banks. We've got huge amounts of fiscal support and government spending. I saw a report from Merrill Lynch a couple of months ago that said that they had calculated that over 20 trillion US dollars worth of monetary stimulus and fiscal stimulus have been poured into the global economy. If you take the World Bank's forecast that, you know, roughly 10% drop in GDP this year worldwide, that 10% worldwide drop is 9 trillion. There's been an awful lot of money thrown at providing support. And let's face it, if we do get a double dip recession or a second wave, I think it's pretty fair to say that there'll be other tools brought into play, whether it's modern monetary theory, further fiscal deficits, zero interest rates, or whatever. So I don't think governments and central banks are necessarily going to stop. And even if things start going well, central banks are now talking about inflation averaging, letting inflation run hot. Now that seems a little bit hubristic to me when they haven't been able to get to the target very consistently. But nevertheless, it's something that they're clearly prepared to tolerate, and that brings again a different round of investment issues. And inflation isn't just prices. I know that inflation is currently pretty lowly, and we're going to get the latest set of numbers pretty in the next week or so. But money supply is going bananas. And if you're an Austrian economist or an economist of the Austrian ilk, then that is something that you will look at, because you'll be looking at money supply going up. And if the supply of products and services doesn't go up commensurately, then they will argue that price increases are sure to follow at some stage. And we're looking at money supply growth here that we haven't seen in 20 or 30 years in the UK on the left and the US on the right. So you can argue that the fuel is there for inflation. What you do now need, however, is that money to circulate and velocity to increase. That will either come down to the banks lending it out more freely, or possibly even, according to some analysts, the central banks circumventing banks using their own digital currencies or their own bank accounts to pump money directly out to people, the people's QE or infrastructure-backed project. And if you get that, maybe, according to the Austrian school of thought at least, you will get inflation with knobs on. And again, that could be perhaps the next irresistible force that markets will have to think about. So this is a key chart to watch going forwards. So in terms of conclusions, well, Ian Wilson, no amount of sophistication is going to allay the fact that all of our knowledge is about the past and all of our decisions are about the future. You know, none of us have got a crystal ball. None of us are necromancers. What you can do is look at valuation and look at what is priced into that, and what is therefore priced in. Well, as soon as anything changes to affect that perception, that's when you get a change in valuations, as we saw quite spectacularly on Monday. But there are three options, as far as I can tell, for us to assess as asset allocators and portfolio builders. We get a weak recovery, no inflation, limp along as pretty much we have done for the last 10 years, in which case, if history's in a guide, what's done well for the last 10 years will do well for the next few years. Long duration assets like bonds, growth stocks. If we get a strong recovery, well, you've all seen it for yourself this week. If there's hopes for a vaccine, you'll see growth expectations rise, inflation expectations rise, equities do pretty well, bonds get marmalized, but also it'll be value rather than growth, shorter duration that will do best within the equity sphere. And then perhaps the trickiest scenario is the one on the right-hand side, a second, a third wave following one could argue the model of Spanish flu of 1918 to 1919. I get a double dip recession, and then you would expect shock and awe from central banks and governments, more monetary and fiscal stimulus, ZERP, NERP, universal basic income, modern monetary theory, you name it. Under those circumstances, equities might do okay and certainly do better than bonds. But if anything, then you're going to be moving from soft assets to real or hard assets, commodities, precious metals, if you believe in the barbarous relic, and also potentially property. So that's all looking at the lessons of history. There are no guarantees that the performance patterns of the past will see us through the future. But if history's any guide, that's what's generally done best during previous examples of those possible scenarios. So it is not easy to judge necessarily, and therefore putting all of your chips on the other probably isn't that wise. And a little bit of stoicism and preparing for anything that can be thrown at you, it makes sense. Having a little bit of each portfolio, each potential scenario would be one way perhaps of preparing for a multiple outcome future. So thank you very much for your time.